It's pretty disappointing, to be honest. You didn't have to raise millions and millions of VC dollars to do this. It doesn't seem like a great use of funds. That's, my own opinion. Today's show is sponsored by Unlimit. Borderless payment, local to local, local to international. More on that later. Hi everyone, hope everyone had a great week. This is Cami Russo, the founder of the Defiant. I'll be going through the biggest DeFi-focused news and also cover general crypto news. So getting to what happened this week, it's kind of the end of a cycle here with the Curve founder, Mike Egorov, paying down a large chunk of his debt. So if you guys remember last month, Egorov had sparked a lot of concern because he had about 100 million worth of loans backed by over 400 million of CRV tokens. These collateralized loans were spread across different DeFi lenders. And after Curve Finance suffered an exploit and the CRV price tanked, that threatened to destabilize and liquidate some of the Curve founders' loan positions. And because of how large these positions are and how integrated Curve Finance is with the rest of DeFi, that really sparked a concern that this would be some domino effect that could bring down all of the major DeFi protocols. At the time, all of major DeFi investors and founders came together to prop up the CRV price in OTC deals, while Egorov scrambled to pay off or top off his collateral. It all came together, and then kind of that risk was mitigated. And now that seems to be further mitigated thanks to the Curve founder paying down his entire debt on Aave. But keep in mind that he still has about 42 million in loans in 4 other DeFi protocols. So still something to watch, but the initial risk that was flagged in August has certainly come down. Moving on to NFT land, there were some news here. The ApeCoin community voted to use some of its tokens to acquire top NFTs through a new DAO. The proposal passed just with over 50% of support. The plan is to secure 750,000 APE tokens from the ApeCoin treasury to fund the community-governed NFT vault. And, these funds will be used to buy NFTs from, art to music, gaming, and others. It's pretty disappointing, to be honest, to see that this token, which was supposed to be the fuel for the Bored Apes NFTs, is being effectively downgraded to be used as an investment vehicle. Bake. I've never known how to say it, but the Bored Ape NFT, it is one of the largest NFT projects, and it was supposed to launch this whole cultural movement with games and movies, and it was supposed to be kind of the Web3 Marvel or Mattel, or just this just major creator studio, and ApeCoin was supposed to be the token that drives it and is at the center of it. That hasn't panned out. If you guys remember, this was just peak previous bull run, 2022 and so on. And Bake received investment at a unicorn evaluation based on this vision. But now this token is being reduced to buying other NFTs, which you could have just done in a simple investment DAO. You didn't have to create this entire NFT project and community and raise millions and millions of VC dollars to do this. It doesn't seem like a great use of funds, to be honest. That's, my own opinion. Now, markets disagree with me. I guess some use for ApeCoin is better than no use for ApeCoin. So here we see the token reacted well. This was announced around September 23rd, and we see that I'm not sure if it's exactly related to the news because the price did rally a couple of days after the announcement, but regardless, the token is up after the news. So again, market seems to be taking this new use case positively. The token is still down over 90% from its all-time high, so it'll take a lot more to improve the situation. Moving on to another positive story for Pudgy Penguins. Really interesting, Walmart is going to be selling Pudgy Penguin toys in 2,000 stores. That's pretty notable. We've seen before how traditional, big brands start to shy away from crypto and NFTs when things get bad and ugly, as they are now. As you guys probably know, obviously NFT floor prices and volumes have crashed in this bear market. But even so, Walmart is going ahead with this plan, which is pretty bullish. And in general, I interviewed the founder of Magic Wallet in last week's podcast, and he was saying that Magic Wallet has a lot of kind of mainstream Web2 company integrations, and he was saying he's still seeing interest from the likes of Mattel and 7-Eleven to create different NFT related projects. So this is, another sign that big brands and companies are not entirely shying away or stepping away from NFTs, crypto, and Web3. So this is really interesting. Floor price of the Pudgy Penguins collection surged 11% after the news. So I'll love to see what these toys look like, and more of these NFT collections coming to kind of real life. Before we continue, a quick word from our sponsor, Unlimit. Grow your business with Unlimited borderless payment solutions. Leverage one of the world's largest proprietary payments infrastructures, available in Europe, LATAM, APAC, Africa, and the UK. Now, back to our show. Moving on to airdrop and token news. There's 56 million worth of Arbitrum's ARB tokens that are being moved to the DAO after eligible users didn't claim their ARB tokens after the March airdrop. So that's a real shame. Remember, if you're a user of any protocol that's being, that's issuing a token, airdropping tokens, make sure to claim this. I'm wondering why Arbitrum didn't take the route of Optimism, which Optimism, they went ahead and just directly sent OP tokens to the wallets of people who had not claimed their airdrops. So I'm wondering why they didn't do that and chose to just return the tokens to the DAO. But keep in mind to claim your tokens. Another airdrop alert, Celestia is announcing an airdrop. So if you guys are Celestia users, make sure to claim those tokens. So it doesn't happen that they get sent back to the DAO. And then another Arbitrum earning campaign, they're rebooting their Odyssey campaign. So this is a campaign where you have to go through a series of steps, and you can earn NFT badges if you participate in completing different tasks. So another opportunity to earn some crypto, some NFTs in exchange for using these networks. And then on to the non-DeFi news. The biggest thing going on this week was there was like a lot of ETF related news. Biggest news is that VanEck and others will launch an Ether futures ETF. So what happened was that many different fund managers filed to list ETH futures ETF as soon as next week. VanEck is one of them. They're a huge asset manager with 80 billion of AUM, and they'll launch a ETH futures ETF as soon as next week. So a reminder that this is an exchange-traded fund that will hold Ethereum futures, so not ETH, the asset itself. So this is an ETF that holds a derivative of ETH, as of course the spot ETFs haven't been approved yet. This would be these ETFs that have filed to list, which include Bitwise, VanEck, ProShares, and a few others, all listed to issue ETH futures ETF next week. They'll be the first to do this for ETH in the US. They're regulated instruments, regulated by the CBOE and CME. And so they will allow for institutional investors to get exposure to ETH via these products. This is very different from having spot exposure. So again, these funds will be buying an Ethereum derivative, not the actual asset. So it's not very clear. So the ETH price rose on this news, but since these funds aren't holding actual spot ETH, it's the relationship between these ETFs being approved and the Ethereum price, it's not so direct. So it's not like these, multi-billion-dollar funds that will be buying ETH directly. They'll be selling more of like derivative sort of exposure to Ethereum. It's still positive because it means there's interest in institutions to have exposure to ETH. It also improves price discovery to have these instruments, which might be a good thing or a bad thing. If you guys remember in the 2017 bull market, the approval of Bitcoin futures ETFs was what marked the top. And some argue that this price discovery, this ability for people to short Bitcoin via these instruments is what ultimately started the downfall of the price. Right now we're in a bear market, so I don't know how much lower it can go. I mean, maybe I shouldn't say that. I don't want to jinx things, but in any case, like I said, the relationship between the futures ETFs and the price is a little bit more indirect than if these were actual spot ETFs that were being approved. And speaking of spot ETFs, the SEC moved again to delay spot Bitcoin ETF approval. As we all know, there has been a lot of pressure from fund managers to list Bitcoin spot ETFs. BlackRock is, the world's biggest fund manager, and they've filed to list a Bitcoin spot ETF. The SEC still needs to approve it, and they've been delaying this decision, and here they are delaying it again. Finally, bad guys going to jail or in jail. So what happened? Three Arrows co-founder Susu was apprehended in Singapore. The Three Arrows liquidator Teneo said. Co-founder Davies is facing at least 4 months in prison. And meanwhile, other bad guy in prison, SBF, was denied temporary release. So just a quick update on, the bad guys of the previous bull run. Good to see some justice being served here. And then to wrap up, here's something not so news related that I'm watching, but there's this kind of new narrative and theme that I've been seeing popping up on Twitter. This kind of consumer crypto narrative. The Seed Club, VC and Accelerator had a consumer crypto demo day. There's Boost VC with also a consumer crypto pitch day. 1KX wrote this essay about it. There's a consumer crypto hackathon by Paradigm. So I've just seen a lot of this term kind of being brought up. And so I started researching to see whether this was actually a new thing. I wanted to see data that was backing, are VCs really just starting to invest in consumer crypto? And is it true that that consumer dApps were less represented, or were being or were receiving less money before? And it turns out that the data doesn't back that. So the narrative is that crypto VCs have been busy pouring money into layer ones and blockchain infrastructure, kind of investing in the picks and shovels instead of the dApps. But this is a bad move, because in the end, you can only have so much infrastructure. You do need applications and consumer-facing products for crypto to get to the mainstream. And so this was kind of the narrative that I've been seeing VCs argue recently. But the data shows that actually being investing in consumer crypto has always been the case. There's been 80% of VC funds have been allocated to consumer dApps, including CeFi, DeFi, GameFi, memes, NFTs, and social and stablecoins in the past 2 years. And 20% of VC funds have gone to chains and blockchain infrastructure. This is the best free source of VC fundraising that I've found, CryptoRank. And here's where I'm getting this data. If anyone has a better kind of aggregate view of venture capital funding, let me know. But this and other reports I saw has shown that infrastructure has taken a minority of the VC cash versus consumer-facing applications. DeFi applications, CeFi, GameFi, NFTs, and so on have taken most of the VC investment. So yeah, just pointing out this narrative isn't so accurate. I think what may be underlying this is kind of this realization that even if it's true that most cash has gone to consumer crypto, maybe valuations have been relatively lower. So layer ones valuations are usually extremely high relative to dApps. And that's because there's this idea that whichever layer one wins will be able to get the biggest share of the market. And so that implies just a higher valuation than as individual dApps. So I think maybe what VCs are arguing now is that actually these dApps should be valued relatively higher. So, there's more incentive to build there and to invest there. But the problem is that for those valuations to make sense relative to infrastructure, which is in the multiple billions of valuations, these dApps would have to show traction to back that, and that traction just isn't there. dApps have the problem that they have to show actual use. They have to show actual people, wallets interacting, volume transacted, and that's a lot harder to prove than layer one's kind of future claims of, we'll be the underlying infrastructure of the internet, and right now they just have to prove that there's a lot of developers building and that the users will come later. I think for dApps that's a harder case to make, and they need to show actual traction. So valuations are lower. So for valuations of dApps to be relatively high versus infrastructure, then infrastructure valuation should come down instead of dApps valuations increasing, because that's just, again, very hard to do with actual use numbers, which is very, very low, especially now. So yeah, that's just an interesting narrative, interesting trend that I'm observing, this consumer crypto meme that I'm seeing from crypto VCs. Yeah, I agree. There's a lot more attention and investment that should go to consumer crypto, but that's always been the focus. Yeah, I think maybe the case is now we need to see those consumer applications actually reach the consumer, actually reach the mainstream. So yeah, we'll see when that happens. Again, I think it's a matter of time, but there's still a lot of work to be done for that to reach kind of beyond the crypto native. But for us still here, us crypto natives still here, yeah, I hope this news roundup was useful. Let me know in the comments, and see you all next week.